Good evening, welcome to Ekcel Academy. Today we'll be looking at CS Executive CMA June 2022 paper. We completed the previous one, which was December 2019. I thought let us jump and look at June 22 because I didn't want to look at the latest one because the chances of institute asking the same question from the previous question paper, December 2022 and again repeating the same questions in June 23, the chances of that is less likely compared to asking questions from the previous question papers. So there are a few questions which are actually repeated. When you read the question paper, you will realize. Anyway, let us straight away get into the paper and check few questions. It may not be possible to check all, but at least few we can definitely check today. Let's see what we can cover today. Rest probably we can cover sometime in the next session, which we can hold sometime next week, because tomorrow, day after, and next day, that is Wednesday, Thursday and Friday, we will be conducting live session for FM, because as far as FM is concerned, we could only hold 2 out of that 1. We had to stop halfway through because of the streaming issues. Hopefully today there won't be any such issue, because right now the speed seems to be fine. If at all there is any problem, then obviously it is at YouTube's end. Anyway, let us straight away jump into the questions now. The first one, this is the first question, which is a very easy question, obvious question. So the question relates to the origin of accounting concept based on double entry system. This was obviously Luca Pacioli. He was an Italian monk or mathematician, depending on which textbook you read, who found out this double entry system. Double entry system means what? Wherein we say the total of debits will be equal to the total of credits. In fact, this entire double entry system is nothing but what we say in mathematics, wherein we say LHS equals RHS, just that in accounts we call it the total of debits equals total of credits. So everything is based on this LHS equals RHS concept. So nothing new there, but very neatly done as far as double entry system is done. So that was Luca Pacioli, an Italian monk or mathematician. Moving on. Which of the following is an example of fictitious asset? Of course, we know what is a fictitious asset. Fictitious asset is an asset which is actually not an asset. Meaning, even though it's not an asset, it is still there in the balance sheet on the asset side as an item. So that would be referred to as fictitious asset. If you look at the provision for taxation is a liability. It cannot be a fictitious asset because it will be shown in the current liability, because it's a provision which we have created with respect to the payment of income tax. So ruled out. Provision for depreciation also ruled out, because again it is not an asset. Cash discount to customers will not appear in the books at all. Oh, trade discount will not appear, sorry. Cash discount will appear, but again it is not an asset because it is not a fictitious item. It is an expenditure. Of course, I'm sure you know the two different types of discounts, cash and trade. Trade discount is a discount which you get even before you purchase. Cash discount is a discount which you get after the purchase, or you may give it. Either you are allowing the discount or receiving. Whether or not you are allowing or receiving, only cash discount will appear in the books. Trade will not appear. So this also is not something which we find in balance sheet. The only thing which is a balance sheet item here is discount on issue of shares. But again, institute shouldn't have asked this question, because now we don't even have discount on issue of shares. Earlier, discount on issue of shares was allowed, but now we no longer have that provision at all. We cannot issue shares at discounted price. Either you can issue shares at its regular price, that means par value, 10 rupees face value, 10 rupees issue price. Whereas in case of premium also you can do. Okay, compliance adda as a message, Hindi mein nahi bol sakte sir. Oh my goodness, if you listen to my Hindi, you will definitely run away. My Hindi is not good. I can understand, but speaking would be very difficult. Okay. By the way, compliance adda, we are a channel based out of Mysore from Karnataka. Of course, we have other channels also. We have a Hindi channel, Ekcel Academy Hindi. We have Ekcel Academy Tamil, Telugu, So why don't you check out those channels also. You can probably watch few videos on our Excel Hindi channel also. Hopefully that should help. Okay, I'll continue in English. Unfortunately, it is my limitation. Okay. Then what else? The third question: what is the nature of a cash book? Again, a problematic question according to me, because these type of questions are difficult to answer because we do not know what the examiner was thinking when they asked this question. So now they say the nature of a cash book is a journal, ledger, both a journal and ledger, neither a journal or ledger. If you ask me in today's terms, see, accounting is a process. It is not like still water, no, it flows. How does it flow? It starts with, of course, recording. Even before recording, we have to identify. That's a different thing anyway. Recording is nothing but journalizing. So first, this is what we do. Whatever it is, first we have to record it as a journal. From there, it goes to respective ledger. Because of the computerized accounting, whether it is Tally, SI, SAP, whatever it is, everything is computerized. All we do is just pass a journal entry and it gets posted to its respective ledger. So how do you classify this as a record? What is this, ledger or a journal? According to the institute thing, this is both a journal and a ledger. So that is what it is right now. So in the exam, if at all you get such a question, select both a journal and a ledger. I wonder how are they going to explain this, but the institute thinks it is both a journal as well as a ledger. So therefore we will have to consider that itself. So there are such questions in this paper. I'm sure there will be such questions in your paper as well. Whichever attempt you will be writing, you will also get such type of questions. So in such cases, what can you do? It's very difficult to answer. Anyway, moving on. In the context of filing of financial statements by a company, the term XBRL means what? So now we have a question here as well. The question is what by Rianshi Kataria. What is XBRL? Again, this, if you have started training, you will know what is XBRL. It is nothing but extensible business reporting language. First, let me tick the right option here. Extensible business reporting language. This is this option B. Obviously not Xavier business rules and law. See, one thing which is good when it comes to students' point of view with respect to MCQ type of exams, you can easily look at this. Even without knowing the right answer, you can still select the right answer for this question at least, because you can eliminate the wrong answers. No, for example, Xavier business laws, not, definitely not. Anyone will know. Xavier business reporting language, why is this Xavier coming into picture here? Incorrect. Extensible business rules and law, again, doesn't look like. So the best possible answer here is obviously B, and that is in fact the right answer. I'm saying if you do not know how to eliminate the least likely answers and then come to the right one. See, this is a standardized language used for electronic communication of business and financial data. See, this XBRL allows for tagging of financial information in a structured format. It makes it easier to analyze and compare data across different companies and jurisdictions. Okay. So many countries, including India, have adopted XBRL as the mandatory format for filing the financial statements with regulatory bodies such as ROC, that is Ministry of Corporate Affairs. So that is what XBRL is. I hope it is clear. Next, as per ICAI guidance note on ESOP, share options outstanding account should be shown in the balance sheet of a company as follows. Again, a problematic question. Problematic not because of the question itself, but because of the options. So even if you look at the guideline answers of institute, there also they are slightly confused as to which is the right one. So they have mentioned the right answer, but again they have messed it up a bit. Let me just read whatever they have mentioned in the guideline answer. As per the ICAI guidance note on ESOP, employee stock option outstanding will appear in the balance sheet under a separate heading between share capital and reserves and surplus. If it is appearing between share capital and reserves and surplus, then which option do you think is the right option? None of them makes sense, no? Which one looks right here? None. Between share capital and reserves and surplus. Now here they say separate line item under reserves and surplus. separate line item under share capital. So when this is the answer, which is, these are the choices which we have, and the explanation is something else, none of the options are actually correct. You can at best say it could be a separate line item under reserves and surplus. It is not actually under reserves and surplus, which is also wrong. It should be between reserves and share capital. Separate line item under share capital. To me, this option B looks fine, but they should be more clear. There, what they have mentioned is either A or B. If student answers A or student answers B, both will fetch the right answers in case of exam. So that is what it is. Anyway, let's move on. According to section 128(1) of the Companies Act 2013, every company shall prepare and keep its books of accounts and other relevant books and papers and financial statements for every financial year, which gives a true and fair view of the state of affairs of the company at its, this is actually very easy, registered office. Every company is supposed to keep the books, everything at its registered office. So if someone wants to know, they can come to registered office, shareholder, let's say, and give the notice and have a look at the books. Of course, with prior permission, they can shift the books from registered office to somewhere else, like what Reliance has done, if I'm not mistaken. Okay. Their registered office is in Gujarat, I believe. Then they keep the books in Mumbai. I think so. Don't hold on to me. Don't hold it against me, but I think that is the correct. Reliance is the one which has done so. Anyway, moving on. As per Companies Act 2013, the prescribed form for statement of profit and loss is given in. So which are the options which we have? Part 1 of Schedule 2, Part 1 of Schedule 3, Part 2 of Schedule 3. See, one thing is sure. Statement of profit and loss will be in Schedule 3 only. So therefore it is either B or C. So here it is Part 2. Okay. So this is also easy if you have studied the chapters and understood the format. There is a separate chapter anyway in CMA. You will know these are all obvious answers. There is nothing much to explain here. The nature of shares of a company is considered as dash: movable property, immovable property, fictitious property, hypothetical property. This is easy, especially if you have studied Sale of Goods Act. So this in fact appears as a definition in the Sale of Goods Act. There they have very specifically mentioned even shares, stocks of a company will be considered as movable property. So therefore this is a movable property. Moving on. What will be the rate of interest on calls in advance in the absence of any provision in the Articles of Association of a company? What they are basically asking is the default rate. What will be the default interest rate when it comes to calls in advance? That means the shareholder has paid well before the company has actually asked the shareholder to make the payment. Maybe the first call has not been made. Even before the first call has been made, the shareholder has already paid. In that case, what is the rate of interest which a company can give? 12% per annum, rate decided by the AGM? Definitely not. Any rate decided by the board? No. Rate decided by the board? Of course, yes. Subject to a maximum of 12% per annum. This is the right answer. The board will have the discretion to decide the rate at which they can give interest, but there is a condition attached to that rate as well. The condition being you cannot go beyond 12% per annum. So that is the thing. Moving on, question number 10. Rule 12 of the Companies Share and Debentures Rule 2014 is related to facts based question. These I have been telling this since a long time, that wherever you see section numbers, wherever you see rules, etc., and wherever you think a possible question can be drafted from that, please mark it in your textbook or somewhere else. So in this case, the right answer is employee stock option. Rule 12 deals with employee stock option. Okay. Anyway, next one is easy actually. Bonus shares cannot be issued by a company out of dash. Capital redemption reserve, definitely yes, but revaluation reserve again is not a valid reserve. We cannot. Revaluation reserve arises out of revaluation of, let's say, fixed assets. So when you are revaluing the asset, if there is an increase in the valuation of asset, it's not a real reserve. It's not as if we are getting any money from that. So therefore, we cannot issue bonus shares out of such a reserve, which is revaluation reserve. Abdul Khan says hello. Hello, Abdul Khan. Welcome to our live session. So the right answer here is revaluation reserve. Next. The maximum amount of discount on reissue of forfeited shares shall be. This is very interesting actually. This again is a very easy answer. Let me just show you how to understand this. You don't have to remember anything if you understand. Let's say a share of a company is valued at 10 rupees face value and issue price is also 10, issued at par. Now let's assume for a second that someone has paid 5 rupees, or 5 rupees would be confusing. Let me make it 6. Someone has paid 6 rupees and that person did not pay the call money of 4 rupees. Couple of calls, first call, second call, everything included 4 rupees. They have already paid application allotment 6. Now because that fellow did not pay, let's assume that they have 10 shares. They only paid 10 into rupees 6, 60 rupees. They did not pay remaining 4 into 10, 40 rupees. Now their shares are forfeited. When the shares are forfeited, whatever they have paid so far, which is 60 in this case, 6 rupees per share into 10 shares, 60, that we will not return to the shareholder. That will still be with us. But we can use that share forfeiture credit amount against any reissue of those shares at a discounted price. Meaning, now what I can do is when I reissue these shares, 10 shares, I can actually reissue at a discounted price. It won't be violating section 53 obviously, because we have collected some money. How much money have we already collected? We have collected 60 rupees on account of those 10 shares. That means even if I collect remaining 40 rupees, even then it will be fine. That means how much discount can I allow? So 100 rupees might be the face value, but I will still be able to allow discount of 60 and collect only 40, because amount already collected plus reissue price should be equal to face value. As long as this is satisfied, you don't have to worry much. So therefore in this case, what is the right answer? Maximum amount of discount on reissue of forfeited shares shall be not exceeding the amount credited to shares forfeiture account. So that means whatever we have credited to share forfeiture account, to that extent we can reissue the shares at a discounted price. So what is the discount maximum? 60 rupees can be the maximum discount, and you can reissue at 40 only, which will still be fine. Okay. So that is about question 12. Let's move on to the next page. Question number 13. Okay, a practical question, interesting one. Let's see. X applied for 200 shares of rupees 10 each in ABC Limited. Fine. But he was allotted only 160 shares. Okay. So this is called pro rata allotment. Of course, you know, they applied for 200, but they only got 160 shares. After having paid rupees 1 on application, he did not pay the allotment money of rupees 2 per share and first call money of rupees 3 per share. Okay. Fine. Since shares were forfeited, what amount will be credited to share allotment account at the time of entry for forfeiture? Okay. So now what exactly they're asking is how much was due from this X towards allotment. How much is due? It is not so easy. We cannot simply do this. 160 into allotment money of rupees 2. 320 is not the answer. 320 is the amount which is due. We can say gross dues. But he has paid something already towards allotment. We'll see how. See, what you have to remember here is he applied for 200 shares. When he applied for 200 shares and paid rupee 1 as the application money, the amount which is with us on account of X's shares is 200. But what we allotted to X is only 160 shares. Into rupee 1, 160. So therefore, 200 minus 160, 40 rupees is still with us. Even though 320 is actually due towards allotment, we already have 40 which he paid in excess during the application stage. So therefore 320 minus 40, 280 is the actual amount which is due from X. That 320 we did not receive. Because he did not pay that 320, we had to forfeit. So this was actually, that 280 we did not receive. And this 280 is the amount which is actually considered as calls in arrears, or also you can not consider it as calls in arrears. If you look at the shared treatment in the CMA textbook study material, you will notice both the treatments where institute has at times created calls in arrears, and in some cases it has not created calls in arrears at all. So institute can be very haphazard when it comes to treatment of certain items, but you will have to read the question carefully and then decide accordingly. In this case, there is no call scenarios because they are very clearly mentioned. Allotment money, where is it? What amount will be created to share allotment? This is the amount which will be created to share allotment, 280 rupees. That means we will have to cancel share allotment to that extent, to the extent which we have not received. 320 was due, gross due, minus already received towards allotment during the application stage 40. So net due would be 280. I hope it is clear. Let me know if there is any doubt. You can also leave a message below, later on comment below once the video is the streaming is ended. Anyway, let's move on to the next one. Again a practical question. Let's see. P Limited has a total subscribed capital of 10 lakh in equity shares of rupees 10 each, that is 1 lakh shares of rupees 10 each, of which 7.5 were called up. A final call of 2.5 was made and all the amounts paid except the 2 calls of rupees 2.5 each in respect of 200 shares held by A. These shares were forfeited and reissued at rupees 8 per share. What amount will be transferred to capital reserve on reissue of forfeited shares? Again, very easy, straightforward question. Here, let us try to understand first. What is that he has already paid? Who is the person here? A, no? A final call of rupees 2.5 was made and all amounts paid except these could. Okay. A has paid rupees 5 per share. How do we know? Because they are very clearly mentioned except the 2 calls of rupees 2.5 each. So 2.5, 1 second, 2.5 plus 2.5 has not been paid. So that means 5 has not been paid. So remaining 5 has been paid. It makes sense, I hope, because there is no premium here. Even if there was premium, we wouldn't have minded, because once you receive the premium, you cannot use it anywhere else apart from the 5 purposes mentioned in section 55. I hope. I don't remember the section. I think it is 55 or 51. Anyway, now where were we? Yeah. So he has paid 5 rupees. Now, since he did not pay the remaining 5, we had to forfeit his shares. So we retained that 5 rupees with us. How much money do we retain? 5 rupees into 200 shares. So 1000 rupees is with us. Okay, with respect to share forfeiture account. Share forfeiture account represents the money which we have received towards those shares which are now being forfeited. Okay, but one more problem here is they have been reissued, actually, which is a good thing. So if they have reissued, at what value have they reissued? So 200 shares into rupees 8, meaning they have been reissued at a discount of rupees 2, because face value is 10, but they are reissuing at rupees 8. So discount is 2. That means how much loss is the company incurring here? 2 rupees per share. So 200 into 2 will be 400 rupees. Benefit is 1000 because we have that 1000 rupees which A has paid and which we are not going to return to A. But out of that 1000 benefit, how much is our detriment or loss? 400 rupees. So net 600 is our benefit. This 600 is not a revenue profit because this is not something which we earned out of day-to-day transactions. So therefore, this will be a capital profit. Any such capital profit will be transferred to capital reserve. So the question is, how much money will be transferred to capital reserve? That is rupees 600. I hope it makes sense. If at all there is any doubt, please do ask. Let's move on to the next one. Again, very easy. When debentures are issued as a collateral security, the account to be debited to record in the books of account is debenture suspense account. This again is a fact-based question. If you know the answer already, so you should be able to select the right one, because debenture collateral security means additional security which we are giving. So sometimes what happens, banks or financial institutions, they insist on something else also as part of security apart from maybe some asset. So then we issue them fictitious debentures. There is no money which is actually coming to us. We are simply issuing to them, saying in the event of non-payment, you can encash these debentures. So then what to debit? We cannot debit bank account, no? So because there is no money which is being exchanged with respect to debentures. So therefore, we will debit a fictitious asset called debenture suspense account. So the entry when we issue collateral security, debentures as collateral security will be debenture suspense account to 10% debentures, assuming interest rate is 10%. So let's say 100 lakhs, 100 lakhs. This will be on the asset side, this will be on the liability side, as long as that loan is active. Once the loan is completely paid off, then we'll simply reverse this entry and cancel this. Kanika Majumdar says hello. Hello Kanika, welcome to live session. Let's move on. Give me a minute. Summer and it's very thirsty. Anyway, let's move on. Question number 16, right? So now again a very easy question related to previous questions. When there is profit on cancellation of debentures, redemption, let's assume for a second that we had issued debentures worth rupees 100 and we are only paying 95 rupees per debenture. For some reason we are redeeming debentures at a discounted price. Sorry. This is obviously profit. Sometimes come interest debentures also works this way, wherein we are paying less. Now what is the profit per debenture here? 5 rupees. Such profit will be easily transferred to capital reserve account. Any capital profit which we earn for transactions which is not operational in nature. This is not our day-to-day operations, issuing debentures. So therefore this would be a capital account transaction or capital transaction, and this profit shall be transferred to capital reserve account. Okay, that was easy. Let's move to the next one. This is also very easy. This is a fact-based question again. As per section 68 subsection 2 of Companies Act 2013, post buyback, comma, debt equity ratio should be how much? So the easy answer is 2:1. That means after the buyback, the minimum debt equity ratio should be 2. That means if we have 100 rupees as debt, we should at least have equity of 50. That means if own funds is 50, the maximum debt which you are allowed to have after the buyback would be 100, double of whatever you have invested. So that's why it's called 2:1. It's a minimum, okay, or the maximum debt which you can avail, whichever way you look at it. Let's move on to the next question. Once again about buyback. Every buyback shall be completed within a period of 1 year from the date of resolution or special resolution, as the case may be, passed by the board of directors. This is a very easy question to remember. 1 year is the right answer. Again and again I have been telling that CMA is something which you cannot study without studying company law. Much of what we study in CMA also depends on how you have studied company law. So especially the accounting part in company law, at least that you should study. I would suggest, if you are preparing for CMA, also side by side read company law. Even though you are not appearing for M1, you can still read it just like that. So which will also be helpful when you decide ultimately to appear for M1. Moving on, next one. A company cannot issue a prospectus or make an offer or invitation to dash persons for subscribing to debentures unless the company has, before issuing such a prospectus, appointed one or more debenture trustees. So here the number is very simple. You cannot issue prospectus or make an offer or invitation to more than 500 persons. That is the right answer. You cannot do that. Okay. So in such a case, first you appoint the debenture trustee, then you can issue the debentures or offer it, whatever, send the invitation, not offer, invitation to more than 500 people. Okay. Just to safeguard the interest of the debenture holders. That's the reason why we have this provision of debenture trustee. Someone who will be acting as a trustee on behalf of all the debentures. So when is that needed? When you are inviting more than 500 persons to subscribe for the debentures of the company. That's the thing. Okay, let's move on to question number 20. X Limited purchased a building worth rupees 4,50,000 and furniture worth rupees 2,50,000 from Z Limited for an agreed purchase consideration of 6,60,000 to be satisfied by issue of 8% debentures of rupees 100 each at a premium of rupees 10%. What is the amount to be transferred to capital reserve account? Very easy question actually. You don't have to. There is so much of unwanted amount of information here, but still we'll see. See, now what is important here is this is a classic case of issue of shares for consideration other than cash. We are not getting any consideration in the form of cash, but instead we are getting consideration other than cash. So what is that consideration other than cash which we are getting here? One is the building, which is worth 4,50,000. The other is the furniture, which is worth 2,50,000. That means how much have we got? We have got assets worth rupees 6 lakhs. Okay. 7 lakhs, my bad, 7 lakhs, but we are not paying 7 lakhs. So first of all, there is reduction in the purchase consideration. From 7 lakhs, they have agreed to sell this at 6,60,000, even though the cost of that is 7. But this 6,60,000 also we are not paying in full. So what the company is doing is they are issuing debentures of what? Of 100 rupees. At what? At a premium of 10%. That means 110 rupees. 10% on 100 is 110. That means what we will be doing is we will be issuing debentures worth rupees some amount for purchasing the assets. So we don't even have to go there. No, we can straight away write the answer. Actually 7 lakhs is the actual cost of the asset, but we are issuing only debentures worth rupees 6,60,000. So therefore the capital profit which we have made is 40,000. Yeah, straight away we can do this. Why simply go for debenture premium calculation? Yeah, easy. That's all. No need to worry about the premium calculation also. 40,000 is the straight away profit. Why? Purchased assets worth rupees 7 lakh, issued debentures worth rupees 6,60,000. So what is the capital profit here? The capital profit in this case would be 40,000. Why simply complicate matters? Straight away when you can get the answer. I hope it is clear. If at all there is any confusion, please do ask. Next, ABC Limited issued 10,000 debentures of rupees 100 each at a discount of 8%, and which are redeemable at a premium of 5%. Problematic question, because the institute itself is not very consistent in its approach. I will tell you why. If you read the institute's journal entries with respect to issue of debentures, you will know why exactly the institute is not consistent here. So I will write the journal entry for this. Issued 10% debentures, no, 10,000 debentures of rupees 10 each. That means how many? 10 lakhs. Okay, this is the face value of debentures issued, but at a discount of 8%. That means we are not getting 10 lakhs. We will get 10 lakhs minus some amount. So that is 8% means 80,000. This amount we will not get because we are giving them a discount of 8% on the face value. So this would be the face value. I hope it makes sense. Then at the same time, they are also saying which are redeemable at a premium of 5%. That means even at the time of redemption, when we return the money to the debenture holders, we are not returning only 100 rupees, which is the face value, but 100 plus 5%. So we are returning 5% extra, 5% on this. So which comes to 50,000. This would be the premium on redemption. Now the journal entry according to the material itself is like this. Debit bank, bank actually. So bank, how much are we getting? 9,20,000. Why? Because we are issuing debentures at a discounted price. Debit discount on issue 80,000. Debit loss on issue. See, this loss on issue refers to the loss which we will incur at the time of any other loss. So here you have to be very careful. What is the loss which we are incurring at the time of redemption? I have already mentioned 50,000. What this 50,000 is? The extra amount which we are paying them. Even though we received 100 or face value is 100, we will be paying 105 per debenture. So 5% on 10 lakh comes to 50,000. So that 50,000 is the loss which I am referring to here. Then 2. What is the rate of debenture? 10%. To 10% debentures face value, which is 10 lakhs, to premium on redemption of debentures. This again we will use at the time of redemption, so we don't have to worry about it now, which will be 50,000. So 10 lakh 50,000, 10 lakh 50,000 on both the sides. Now if you look at the loss here, strictly speaking, the loss which the company is actually incurring only to the extent of loss is how much? 50,000, no? But if you look at the guideline answers, they have very clearly mentioned it is 1,30,000. Basically, they have considered discount also as loss. In the material, this is what the institute does. But in the exam, they ask a completely different question, which is wrong. But they have done. Can't help. Let's move on to the next one. So now, if at all you get such a question, please treat discount also as loss. That is my whole point here. Okay, discount is 80, loss is 50. Both put together will be 1,30,000. No, consider that itself as loss. In the exam, we'll have to do that if we have to get marks. Let's move on to the next one. As per the provisions of Companies Act 2013, it is required that if a company is not able to collect -% of the offer amount, then it needs to compulsorily return the money to those who have subscribed to the shares. Basically, let's say you issue shares worth rupees 10 lakhs. No one issues shares worth rupees 10 lakhs anyway, but still, how much should you get as subscription for this issue to be considered as successful according to Companies Act? So that is 9 lakh, meaning we should at least receive 90% of the offer amount. Offer was 10 lakhs, we should have received at least this much for that issue to be considered as a successful one or something which is valid. Otherwise, what we'll have to do, we'll have to return the money to the subscribers, the ones who have already paid. We'll have to return that money if you don't hit that threshold limit of 90%. So that is the thing. Again, this is based on some section, I don't remember which section. Earlier this was only according to the SEBI provision. Now it is inserted in one of the sections in Companies Act. I don't remember the exact section number though. I think 30 something. I'm not so sure. Some 30 section. I think so. I don't know, vaguely remember. Anyway, you can check it out. It may not be important here in CMA, that is the section number, but definitely important in company law. Just have a look at it later on. You can do that later. Let's move on to the next one. Question number 23. Let's read this first. What do we have here? Question 23, where is it? Yeah. In 2016, A Limited issued 12% 50 lakh debentures at a discount of 8%. The debentures were redeemable in 2020. 2020 now being redeemed. In 2020, the company gave the debenture holders the option of converting. That means the shareholder can either get the cash from the company or they can convert their existing debentures into shares. So one debenture holder holding 2 lakh debentures wanted to exercise the option. What is the face value of the shares which he will get? Very easy question actually. So very simple here. Premium, they say here, if you read this, company gave the debenture holder the option of converting the debentures into equity shares at a premium of 25%. Okay, so at a premium of 25% means you won't get everything. You will have to settle for something less than what you have paid for. So even though the face value of the debentures which is being converted is 2 lakhs, because they have mentioned one debenture holder holding 2 lakh debentures. Now if I divide this by 25%, how much will I get? No, premium of sorry, why did I divide? Multiply into 25%, or in other words, I can also do this way. 10 rupees share, no, normal face value of the share is 10, issued at 25% premium. That means 12.5. 25% on 10 would be 2.5. 2.5 plus 10 will be 12.5. So 2 lakh divided by 12.5. That's all. That would be per share. Even that may not be correct actually. 16,000 shares. Yeah, 16,000 shares of rupees 10. So 1,60,000. Yeah, done. That's all. So what is the face value of the shares that he will get? 1,60,000. Okay, let me explain this once again. He holds 2 lakhs worth of debentures, but he is not getting 2 lakh because whatever shares which he is being given instead of debentures, those shares are valued at what price? 12.5. So even though he has 2 lakh worth of debentures, we'll have to divide by 12.5. So when you do that, you will get the number of shares which he is being given, which is 16,000, multiplied by face value, which is 10 rupees. You will get 1,60,000 as the answer, the face value of the shares which we are issuing to this particular debenture holder, who right now holds 2 lakh worth of shares. Okay, fine. That was question number 23. Let's move on to question number 24. In case of a buyback, theory based question, there are many questions related to buyback actually. So far it's been an easy paper. In case of a buyback of shares, passing of special resolution by a company is not required. This we know. If the buyback is 10% or less of the total paid up share capital and free reserves. So option B is the right answer. I don't even know how to explain. This is a provision with respect to buyback. So if you have studied the buyback provisions, you will know the right answer just by looking at the options. Don't get confused with option A, because there they have not mentioned the free reserves part, whereas here they have very clearly mentioned the free reserves part. So that is the right option here. So let's move on. Question number 25. The escrow account under regulation 911 of SEBI buyback of securities regulation 2018 does not include. Frankly speaking, I did not know. I had to look it up. According to that escrow account under regulation of SEBI, etc., what it does not include is deposit of acceptable securities with appropriate margin with a scheduled commercial bank. See, I don't expect students to know these type of questions. There are certain questions for which you will not know the answers. Don't worry. Even if you attempt 80% of the questions and get 80% of that, still you are safe. Why? Because 80 into 80, at least you'll get 64. So such questions will be there here and there. 10% of the questions will be like way out of your league. I mean, you won't be able to even remember such obscure things which the institute so stupidly asks. So then don't worry too much about it. Just leave it and attempt the rest of the questions. Moving on. In case of issue of equity shares with differential rights as to dividend, voting or otherwise, the shares with differential rights shall dash of the total post-issue paid up equity share capital, including equity shares with differential rights issued at any point of time. Again, a problematic question because none of the options are actually correct. Okay, so let me read the question once again. In case of issue of equity shares with differential voting rights, you know differential voting rights, I don't want to explain that. As to dividend, voting or otherwise, the shares with differential rights shall not exceed 74% of the total post-issue paid up equity share capital. It's a limit set by the law. That limit is 74%. It shall not exceed how much? 74% of the post-issue paid up equity share capital, including equity shares with differential rights. So that is the correct answer. None of the options given here are correct. Unfortunate, but that is what it is. Moving on. Public companies are required to issue audited financial statements to the public at least, this is easy, every year. That is what they are supposed to do. Every year they have to issue, not half year, quarterly or month. Once in a year is fine. Otherwise it will be too much of cost. Anyway, time is also wasted unnecessarily. Financial statements are prepared with an objective to provide information about financial position of the entity, balance sheet, performance and changes in financial position of the entity, profit and loss statement, cash flow during the year, cash flow statement, all of the above is the right answer. Very easy question. All these things will be there as part of the financial statement. So therefore all of the above makes sense. So we click or select all of the above. Next, when the effective capital of a company is 5 crore and above, but less than 100 crore, effective capital is greater than 5 crore, but less than 100 crore, not even equal to, less than 100 crore. The maximum remuneration payable by the company to its managerial person when the company has inadequate profits. That means company does not have sufficient profits to make the payment of managerial remuneration to the directors. And what is the other catch here? The condition is capital of the company is between 5 and 100 crores. Okay, 5 crore and above, but less than 100. In such a situation, what is the maximum remuneration payable to the directors? So this again is a factual question. The right answer is 84. There is nothing much to explain here. You should know the answer. That's all. Okay. Lakshya says good evening. Good evening. Vasant Kumar has given the right answer. 84 it is indeed. Moving on. Question number 30. Every company having turnover of dash during the immediately preceding financial year shall constitute a corporate social responsibility committee. Very easy question. 1000 crores. That's all. Previous year, if I had 1000 crores of turnover, next year I will have to set up CSR committee. That's it. Okay. Next. Company in which only majority of the shares are owned by the holding company, it is said to be dash. Okay. This question is not properly framed actually. It's a very horribly framed question. I will tell you what exactly is the meaning. Assume there is a company called A Limited and it holds, let's say, 59% of shares of B Limited. Now, this is the question. A company which only in which only the majority of the shares, okay, that company is actually B Limited in our example. Never mind. A company which is B Limited, in which only the majority of the shares are held by another, which is the holding company, it is said to be dash. It is not a fully owned subsidiary. Fully owned subsidiary means A Limited will have 100% stake in B Limited. Whatever shares B Limited has, everything belongs to A Limited. In that case, it would be fully owned subsidiary. Here, they say only the majority of the shares. What is the majority here? Simple majority. More than 50%. In this case, 59%. So then it is not an associate company. It is not a joint venture. It is obviously a partly owned subsidiary company. So Lakshya says it would be a partly owned company. Yes, of course, she is right. It's a partly owned subsidiary company because we do not have 100% stake in that subsidiary company. Therefore, it becomes partly owned. Next, question number 32. Again, theoretical question. The main purpose of the preparation of consolidated statement is dash compliance of AS 21. Of course, AS 21 compliance is there. To satisfy the legal provisions of the Companies Act, that is also there. To reflect a true and fair view of the position and the profit or loss of the companies of the holding company group. This is the most ideal answer. Let's look at option D as well. To reflect a true and fair view of the position and profit or loss of the holding company. No, obviously not D. So we are worried about the group company, because imagine a company, imagine Tata. Okay. So for example, Tata Steel Limited is the holding company. They have various subsidiaries. Let's say some 15 subsidiary company. Now I want to know not only the standalone position of Tata Steel Limited as to how they have performed individually as Tata Steel Limited. I would also like to know what is the overall group position, meaning there are 15 subsidiaries of Tata Steel. No, how have they performed? When you consider everything, what is the situation? What is the financial situation? What is the performance? Financial situation, balance sheet, performance, P&L. So to reflect a true and fair view of the position and the performance of the holding company group, we have to prepare the consolidated statements. So therefore, option C would be the right one. Okay. Oh, Lakshya? Sorry. So it's a he, apparently. My mistake. Moving on. Next. If the holding company's year-end stock includes 2,70,000 goods invoiced to it by its 60% owned subsidiary at cost plus 25%, what is the amount of unrealized profit? Easy question. Again, subsidiary, holding company, that is consolidation related problem. What is irrelevant here is 60%. Okay, not relevant for us. What is relevant here is subsidiary company has sold to holding company. Okay, how much? 2,70,000 worth of goods. This would be the sale price. Okay. Now, but they say subsidiary has sold it at cost plus 25%. So they're telling us from the point of view of the subsidiary. So therefore, if for subsidiary, if the cost is 100, profit would be 25%. Cost is 100, profit 25, so 125%. Okay, so this would be the selling price. In selling price, how much is the profit? So 25 by 125, which is nothing but 20%. 25 by 125 into 100 you can do, you will get 20%. That means what? 25% on cost is nothing but 20% on sales. So therefore, on 2,70,000, which is the selling price from the point of view of holding company which has purchased from subsidiary, it will be 2,70,000 into 20%, which is nothing but 54,000. That's it. So the answer in this case would be option A, which is 54,000. Okay, Vasant Kumar, I hope you understood the right option. Let's move on to the next one. So this would be the last set of questions which we will be solving today. Okay, company's auditors report order 2016. Why institute? Why? We are already in June 2022. This is June 2022 paper, and institute is still asking about CARO 2016 when the study material has CARO 2020. Okay, I wonder when will institute think. Anyway, company's auditors report order 2016 was issued by the Ministry of Corporate Affairs. The very first line, if you read the CMA material where they have mentioned CARO, this is the very first line which you see. It is issued by MCA, Ministry of Corporate Affairs. Question number 35. CARO 2016 applies to a private limited company which has a total revenue disclosed in Schedule 3 of the Companies Act, including revenue from discontinuing operations, everything put together, dash exceeding dash during the financial year as part of the financial statements. According to CARO 2016, this value was 10 crores. Again, factual, completely law related, nothing to explain there. Again, one more question related to legal provision. Every non-listed company must have at least one woman director if it has a paid up share capital of at least 100 crore. That means if your share capital is 101 crore, have a woman director. If your share capital is 100 crore, have a woman director. 99, not required. Okay. Then cash flow related question. Easy question actually. Debenture interest paid is 1,20,000. Provision for taxation is 1,10,000. Preference share dividend paid is 80,000. Proposed dividend on equity shares is 1,80,000. Then the cash flow from financing activities is dash. See, financing activity is the activity which is related to raising money. So where have you raised money here? Debenture interest related to raising money. Provision for taxation not related to raising money. Preference share dividend related to raising money because we would have raised money through preference shares. Proposed dividend on equity shares can also be considered as a financing activity. But how many financing activities are there? Debenture, preference share, equity share, dividend. But the problem with the equity share dividend is it is only a proposed dividend. That means we are not yet paid. Here we are talking about the cash flow. No, cash flow only comes into picture with respect to amount paid or amount received. So how much have we paid so far? Debenture interest 1,20,000 plus preference share dividend 80,000. So both put together it is 2 lakh. That's all. So cash flow from financing activity is 2 lakh rupees. Let's move on to the next one. Last question for the day. Plant and machinery original costing rupees 13,55,000. Original cost is, okay, let me just write down for understandability sake. 1355 is the original cost. Accumulated depreciation is 728. 728 is the accumulated depreciation so far. So therefore, what is the book value? So 1355 minus 720. 1355 minus 728. So 6,27,000 is the book value of the asset. Fine. Now this was sold at a profit of 1,59,000. If this asset, which is whose book value is 6,27,000, if it is sold at a profit of 1,59,000, then the sale price of this asset would be book value, which is 627, plus profit, which is 159, will be 7,86,000. This would be the sale value. That means we have sold the asset at 7,86,000. That means we have received so much of cash flow. Okay, so cash flow from this transaction is 7,86,000, option B. Fine. In little less than 1 hour we have been able to solve 38 questions. I'm sure in the exam you'll be able to solve these questions at a much faster pace. So actually time is not an issue at all with respect to CMA, I believe, because there is a healthy balance of theory and practical questions, so that way you don't have to worry too much about time. Thank you for attending the sessions. Hopefully sometime next week we will be able to continue this. Tomorrow we will be doing a live session of FM. We'll continue from where we left last week. We had some streaming related issues. Today thankfully there was no such thing. Tomorrow also hopefully we'll have the same excellent connection which we had today. Thank you guys. If at all you have any doubts with respect to any of the questions which you have solved so far in the class, please do leave a comment below. We'll get back to you. Thank you guys. All those who attended, Divya just commented just now. The others have already addressed. Thank you guys. See you tomorrow. Bye bye.